Ray Dalio moved 30% of his portfolio out of dollar-denominated assets in the first quarter of 2026, and the memo his team published explaining why should be the most important document you read this month. There is one item on this list that Dalio specifically named as the highest priority for households under $250,000 in net worth. Most people have never considered buying it. By the time we reach number 3, you will understand why he called holding cash, quote, a form of slow surrender to the central bank, end quote. The dollar has lost 22% of its purchasing power since January 2020. That is not an opinion. That is the Bureau of Labor Statistics Consumer Price Index. But what Dalio laid out in his April 2026 paper titled How the World Has Changed is that we are not inside a correction. We are inside a structural transition away from dollar dominance. He projects an additional 15 to 20% devaluation over the next 18 months as the Federal Reserve stays trapped between inflation above 3% and a federal debt to gross domestic product ratio sitting at 124%. The last time that ratio was this high was 1946, and it took 12 years of financial repression to bring it back down. Financial repression means your savings lose value slowly and deliberately, while the government inflates its way out of debt. You are the counterparty. Therefore, the question is not whether prices will rise. The question is what you own when they do. Here are the 5 assets that protect your purchasing power before this window closes. Number 1. Physical silver. Gold gets all the attention, but silver is where the asymmetric opportunity sits right now. Gold is trading at $3,100 per ounce. Silver is at $32. The historical gold to silver ratio is 16 to 1. Today it sits at 97 to 1. That gap does not close slowly. In 2011, when the ratio corrected, silver went from $18 to $49 in 7 months. Early buyers tripled their purchasing power while everyone else watched from the sidelines. Dalio wrote in Principles for Dealing with the Changing World Order that hard tangible assets are the first line of defense when fiat currency devaluation accelerates. Silver qualifies on 2 fronts. First, as a monetary metal. Second, as an industrial metal with structural demand from solar panels, semiconductors, and electric vehicle batteries. Solar panel installations globally are projected to require 420 million ounces of silver in 2026 alone, up from 280 million in 2021. Demand is rising from both directions simultaneously, while mine output has been flat for 4 straight years, by 1 to 5 ounces per month from a registered dealer. American silver. Eagles from the U.S. Mint are the most recognized and the easiest to liquidate. Do not buy certificates or ETFs. Physical only. Unallocated silver is a promise on paper, not a holding in your hand. Therefore, that is your hard asset base covered. But the second item works differently because it does not hold value by sitting still. It generates income that rises with inflation automatically. Number 2. Treasury. Inflation-protected securities. TIPS are the most misunderstood instrument in American personal finance. Most people believe bonds are dangerous when interest rates are high, but TIPS are not regular bonds. Their principal value adjusts upward with the Consumer Price Index every 6 months. If inflation runs at 4% this year, your principal grows by 4%. You then earn interest on top of that adjusted value. The current real yield on 5-year TIPS as of May 2026 is 2.3%. That means you are beating inflation by 2.3%, guaranteed by the United States Treasury. No certificate of deposit, no money market account, and no high-yield savings account offers a return indexed to inflation itself. They offer a fixed rate while inflation moves freely above them. You buy TIPS directly at treasurydirect.gov with as little as $100. No broker, no commission, no fees. Series I bonds also qualify and currently yield 4.28% through October. The annual purchase limit for I bonds is $10,000 per person. If you are married, that is $20,000 per household per year in inflation index savings. Therefore, your liquid savings are now protected from erosion. But the third item is where most people lose real money simply by waiting 60 days too long. Number 3. Major home appliances and electronics. Here is the number that should permanently change how you think about every appliance you own. The average washing machine contains $46 worth of steel and $22 worth of semiconductors. Both categories now carry tariffs of 25% or higher under the current trade framework. Whirlpool announced list price increases of 8 to 12% effective July 1st. LG confirmed the same increase. Samsung is expected to follow by August. These are not speculative adjustments. They are published pricing notices already in circulation to retail partners. If your refrigerator is 7 years old, it will fail before any inflation hedge you buy today pays off. The correct move is to purchase the appliance now at pre-adjustment pricing. A refrigerator that costs $1,400 today will cost between $1,600 and $1,700 by September. That $300 difference is permanent. It will not reverse when tariffs ease because manufacturers will not lower list prices after consumers accept the new baseline. The same logic applies to laptops, dishwashers, air conditioners, and any electronics assembled in South Korea, Taiwan, or China. Make a list of every appliance in your home that is more than 6 years old or showing signs of wear. Buy what you actually need and would replace within 2 years, not what you want, what you need. Therefore, that covers your physical goods. But the fourth item is not a product at all. It is a financial decision that becomes more expensive every single month you delay. Number 4. Pay down variable rate debt. The Federal Reserve has held rates between 4.5 and 5% for 18 consecutive months. The market is pricing in 0 cuts before December 2026. But here is what does not make headlines. Torsten Slock at Apollo Global Management published research in April showing that 42% of adjustable rate mortgages in the United States will reprice within the next 24 months. When they do, the average monthly payment increase will be $640 per household, $640 every month with no end date. If you carry a home equity line of credit, a variable rate auto loan, or a personal loan with a floating rate, you are holding a liability that gets more expensive while your dollar buys less. The sequence is the worst possible financial outcome. Paying down variable rate debt at 22% annual percentage rate is the mathematical equivalent of earning a guaranteed 22% return. Nothing else on this list matches that math. No silver, no tips, nothing. Call your lender this week and ask about a fixed rate conversion on any variable product you hold. If you carry high-interest credit card balances, every minimum payment you make is a wealth transfer to your bank, while your purchasing power declines simultaneously. Therefore, once your liabilities are stabilized, the fifth item is the foundation that makes every other asset on this list actually function. Number 5. 3 months of cash in a high-yield savings account. This is the item Dalio specifically named for households under $250,000 in net worth. His exact words from the Economic Club of New York were these, quote, "The biggest risk to the average American is not losing money in equities. It is not having liquidity when a crisis forces a fire sale at the worst possible moment." End quote. 3 months of living expenses in a high-yield savings account is not a saving strategy. It is a defense mechanism. It is the difference between selling your tips at a loss to cover a broken water heater and holding your position while the market corrects around you. Without this buffer, every other asset on this list is fragile. One emergency, and you are a forced seller at the worst time. Ally Bank, Marcus by Goldman Sachs, and Discover Online Savings are all currently paying between 4.3 and 4.6% annual yield. That rate is variable, but your goal is not return. Your goal is to hold liquid capital that does not lose 3% per year sitting in a standard checking account. Calculate your monthly expenses. Multiply by 3. That number is your target balance. Set up an automatic weekly transfer today and do not touch it. The 5 assets are physical silver as your hard asset base, Treasury inflation-protected securities for savings that move with inflation, major appliances and electronics purchased before tariff repricing hits retail, variable rate debt eliminated before the next repricing cycle destroys your cash flow, and 3 months of liquid savings as the foundation for every other move on this list. Open treasurydirect.gov tonight. Find a registered silver dealer and place your first order. Pull out your appliance list and make 2 calls tomorrow morning.